G'day everyone, welcome back to Pete's Investing. Today's video comes from a question raised by a viewer. They ask, how many times do you average down? And is there a limit to the number of times you should average down? Thank you, Sil, for this excellent question. Many new share traders jump to learning a trading strategy and then hurry to put money into the market to buy stocks, FOREX, currencies or other instruments without first understanding the basic fundamentals to improve the probability of safe investing. After viewing this video, I strongly recommend you watch the following videos to support what I will cover in this video. The links are in the description below. Each video is relatively short in duration, about 20 minutes, so I strongly suggest you watch these to help your understanding of what we'll cover in this video. First video is money management. In this video, I'll cover how much you should invest per trade depending on your current income and opening account balance using a sample portfolio. This prevents you from overcapitalizing and blowing out your portfolio, which will only lead to loss of money and ultimately demoralization towards share trading. The second video I recommend is the average down do's and don'ts. This video shows the effect of averaging down too often and how to optimize the frequency of adding to your positions when averaging down. I frequently analyse new strategies and compare and rank them in this table showing revenue potential and drawdown effects. Over many years, I have backtested many strategies to capture the effects of significant downturns in the market to see how that affects your holdings. Backtesting includes down periods such as the GFC, COVID, and more recently the Ukraine-Russian conflict and recessionary events. Reference any of my strategy videos on my channel to paper trade and then test their effectiveness. I've also added some of the best performing strategy videos in this description below, so let's get started with this video. If you're a frequent viewer of my weekly updates, you'll notice I show the weekly, daily and the hourly charts to trade. So here what we're doing is we're showing the price chart here and the price chart there and also a price chart on the hourly. So we're also using here the CCI 1500 indicator for the weekly and daily charts. So what we're doing here is we're only taking long trades in the direction of the weekly and the daily. So I'll draw a arrow indicating where you take long trades on the weekly. So from that point, which equates to that start of where that moving average, the CCI breaks above the moving average, up until that point there when it breaks below the moving average. So on the weekly, that's where your primary bias is going long, and that also transpires on the daily as well. But on the daily, you would take long trades during that period up until there, and you would take short trades only. So if you look at that where the CCI breaks down from the moving average, so from that point onwards till today. So in other words, you take long trades. So to summarize it, the weekly bias is going long up until there, but the daily bias interrupts that and says, right, you can start taking short trades from that point. So theoretically, you can only take long trades up to there and short trades from there to today. So what that looks like on the hourly chart, long trades up until this point. Now you'll notice there's minimal entries, averaging downs made going long. So you want to minimize the average downs. You can see there going, had you gone long, had you gone short, there are more average downs on the short periods. So you want to minimize the average downs to minimize your exposure. So going long only up until that point, that shows you the number of average downs you would have made and your profitability. So you stop going long at that point, and then start going short from there on. And you would have done all those in the short trades. Now you would have had a few average downs done there, but you can probably apply that and narrow it down even more. So you could probably do this on the daily, break it down on the 4-hourly chart. So where we said we'd go short from there, you look at the indicator down here. So originally going short there, and at that point you would stop. You would stop at that point there. So in other words, going short at that little period there. Do not go long there because you're still in a downward trajectory on the daily chart. So you go short again from that point up there down to that point. Okay, so that's where you'd start taking short trades only. So in other words, you can trade on the smaller time frame using a lower time frame on the chart above. Now I'm using the daily, but you could also use the 4-hour chart to show the overall trend if you want to narrow it down and get rid of these peaks and troughs. This is the gold price chart. and analysis. So you can see here on the weekly, the daily, the weekly bias is going long up until there, so you only take long trades up until that point, but you'll notice there's a lot of ups and downs in that period, but you only take long trades. And then where do you start and stop taking long trades? Again, we're looking at the period from the end of 2020, so let's look at that period from there, and you'll notice there is no long period. It starts there going long, but here on a daily chart it's showing to go short. So in other words, you do not go long at all, and you wouldn't even go short until you break that point there, right up until this point here, because that equates to the going short on the weekly. In other words, all this period you would have stayed out of the market for the gold trade until that point there, when it equates to going short at that point there when it drops below the moving average. So that is the only opportunity you would have gone short in the market. So how that looks like, again, from that point there in the market, about that point there, you would have gone short until today, and you would not have traded earlier because that was going short and that was going long. That's contradicting each other. You only want to go in a direction where both the weekly and the daily are in alignment. So you would have only taken the short trades there, and you can see there on the profitability charts there's minimal averaging downs happening. So you would have made those little gains there. You would not have traded that earlier on, and you would not have gone long during that period, because you can see there the huge amount of average downs that would have accumulated. What I'm doing here in the program, I'm just showing you the total ups and downs of the averaging down had you gone all shorts and all longs, but I'm telling you to filter out the shorts which are not applicable and the longs which are not applicable. Again, go back and refer to any of my strategies posted in the past and some of the links in the description below, and only trade in the direction where the weekly and the daily indicators are in alignment. So don't trade across the board long and short. Make sure they're both weekly and daily indicators are in alignment before taking the trades to average down. Here are some of my investing rules: buy proven blue chip stocks, buy stocks which pay dividends, don't short positions, go long only. The reason for that is you want to receive those dividends when they're paid, and don't trade on news. Price is already factored in the share price. Thanks for watching. Don't forget to click the subscribe and the like button, and click the notification bell to get all updates. Market updates will be posted on Mondays and Thursdays each week. If you want to support the channel further, then subscribe to the Patreon page. The link is in the description below. Happy investing, and speak to you in the next video.